So first, I want to get your reaction to that flash read of GDP for the Eurozone. Also, that mixed inflation report out of the UK. How do you see that impacting the international markets and potentially the U.S. markets?
Well, let's start with the mixed inflation report. The most important thing to focus on is core inflation, because the world has a core inflation problem, and it's stickier than we all would have hoped. And that's, again, what you see in the UK, which has had the biggest inflation problem in the whole of Europe. Core inflation is still sticky, and it's sort of 3 times what the Bank of England has in terms of target. So this structurally higher inflationary environment that we're in, that's yet another proof point. So I think that's the main thing there. And in Europe, you can look at it on 2 sides. On one side, you can say, gosh, in October of last year, had we known we would end up with a GDP at this level in Europe, we'd all be extremely happy. We were talking about a deep, 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 dark recession for Europe then. On the other side of the table, it's the issue that we've got complacency, that the economy is slowing down, but you don't see it in markets, in equity markets.
That's a really great point. Right now, we're looking at the European markets, not seeing a deep impact either way from that GDP read. But we are seeing the Asian markets kind of having a negative impact from what we saw here in the U.S. Do you see this interconnectivity and this cyclical situation continuing going forward? And our U.S. markets, are they looking for some reason to pull back? We're going to talk more about that later in the show. But after such a big run-up, is that just generally investors looking for a reason to pull back?
Yeah, and we've been using words like markets climbing the wall of worry for years already, right? Let's be honest. The only thing we need to be extremely careful about is, let's remember those acronyms: TINA, there is no alternative. TRINA, there really is no alternative. This time, there is an alternative to equities, and that's bonds. And if you can get a 4% yield risk-free, 5% by adding very limited risk, it is always extremely tempting to move from equities to bonds. And that's why the movements from one side to the other can be much sharper, much more aggressive, and more volatile than we've seen in the last 10 years.
Yeah, we're spending a lot of time talking about the international markets. One other thing I want to talk to you about is China and its GDP forecast saying they believe they'll be below their 5% GDP growth target. And then at the same time, we have a downgrade of U.S. banks, including possibly J.P. Morgan and other big money center banks. We're talking about international things and big macro things. Which one of those two do you believe will have the biggest impact on the U.S. markets today?
I think, there's a lot of talk about banks, but again, we have to zoom out. The banking system in the U.S. is healthy. And yes, there are areas within regional banks that we need to watch more carefully, and there could be consolidation there, and commercial real estate's an issue. But the larger banks in the system are healthy, looking at any ratios you want to look at. What's more important is probably the China story. Why? Because all eyes are on whether or not the central bank there is really going to start the stimulus engine. And thus far, it just hasn't happened. You've seen a property crisis. You've seen. So I think that's potentially more interesting.
More interesting or more impactful when we talk about the U.S. markets?
Yeah, probably more impactful indeed. Could be, depending on what decisions are made, of course.